One of the first principles of money is to realize that you finance everything you buy. You really only have two options when you make a purchase. You can pay with cash or you can pay with credit. When you pay with credit, you're using somebody else's money and you must pay them interest. But something that's probably never comes to mind when you pay cash is that you're still financing the items you buy because you're giving up the interest you could have earned on your money if you just left your money where it's at. Now, what happens when you get paid? You put your money into someone else's banking system. You put it into your bank account. And from there, you either save it, you invest it, you spend it, or you give it away. You never create value from your money. Now, of course, you can buy assets such as stocks or real estate that create value. But once you shift those dollars off your balance sheet, the dollars themselves never create value for you again. Every dollar you earn has the potential to generate growth for the rest of your life. But when you pay with cash, you lose that opportunity of growth because you're shifting all of those dollars off your balance sheet and onto someone else's balance sheet. And those dollars create value for them. You either pay interest when you use other people's money or you give up the interest when you use your own money. Either way, you're financing your purchases. Now let's show a quick example that shows your money has value. Now let's pretend you earn $50,000 a year for 30 years and you never spend that money. You'd have about $1.5 million. If you could earn 5% compounding growth on that money every year, you'd end up with over $3.7 million. Now, of course, you've got to spend money to live, but you don't have to give up the growth of your money. Now, by running your money through someone else's banking system, you're losing out on all future value of your money. Now, in this example, the way you're running your cash could cost you over $2.1 million over 30 years. And that's just in the interest you're losing. That's not including opportunity cost. And that is while you're only making $50,000. What if you make $100,000 or $1 million? This chart depicts your wealth curve when you run your money through someone else's banking system. You save money, you save money, you save money, you spend money. You save money, you save money, you save money, you spend money. Your money never creates value. Now, instead of shifting your wealth away from you and losing all future value of your money, you can capture the value from every dollar you earn, and you can keep your money growing for your entire life. And this happens by making just one small adjustment to your cash flow. Now, because life insurance is an and asset, you deposit money into your family banking system and you leverage your policy so your wealth continues to grow even when you're using your money somewhere else. This is your wealth curve when you run your money through your family banking system instead of running it through someone else's system. You borrow against your policy. And even though you're paying interest to the insurance company, your money continues to grow uninterrupted. And over time, your compounding growth curve looks like this. Borrowing against your policy will keep your wealth growing uninterrupted for 20, 30, 40, 50 years, and your wealth does nothing but continues to increase. Now, once you understand this principle, it's going to change how you think about money, and it's going to change how you think about your cash flow. Now, I'm going to show you how you can make a profit when you borrow money to buy a car. And the same principle applies when you buy a house, when you put your money in the stock market, when you buy equipment for your business, or when you go on vacation. I'm going to use the scenario of purchasing a car just because it's very relatable. I'm gonna assume that the car is gonna cost $50,000. I'm gonna put $50,000 in a future value calculator. Let's assume you got $50,000 in savings account, earning 4% interest, and it's time to buy a car. Now, you've got a choice. You can borrow money from the bank to pay for the car, or you can use your cash to pay for the car. And you're thinking to yourself, man, I hate the bank. I don't wanna deal with the bank. I don't wanna deal with a monthly payment, and I don't wanna pay them interest. You're thinking about paying cash, but you're not sure if you want to let go of the cash inside your account because you want to keep it for a rainy day. You go to your banker to find out the interest rate for a loan, and you tell your banker what you're thinking, but your banker says, hey, hold up. You've got your money sitting in this account earning 4%. I've got a proposal for you. Now, how about instead of you pulling out your money to buy the car, how about I lend you the $50,000 and we use your savings account as collateral? I'll give you a $50,000 loan and I'm going to charge you 6%. And at the end of the time period, your savings account earning 4% will actually earn more interest than what you're going to pay on your 6% loan. The question is, do you believe this guy? If you're like anyone else I've ever talked to, the first thing you're going to say, no, he's a liar. He's just trying to scam me. Everybody knows 4% is smaller than 6%. I'm going to lose money. But I'm here to tell you that your banker's actually telling you the truth. Let's say you go ahead and you borrow 50 grand from him. You're paying 6% interest. We're going to assume you pay him back over 60 months, which is a typical car loan. So $50,000 loan at 6%. It's a monthly payment of $966. Over 60 months, you send the bank a total of about $58,000. So that's $50,000 of principal you borrow, which means you pay the bank about $8,000 of interest. But remember, because you chose to use your money as collateral, it never left your account. So we got $50,000 earning 4% for 60 months. Over that time period, that account has grown from $50,000 to almost $61,000. So that means you just made $11,000 of interest in your savings account, and you only paid the bank $8,000 of interest to borrow their money. So you actually make a profit of $3,000. So how did this work? Well, here's what's actually going on. Now, this loan balance is always decreasing. So the loan is an ever decreasing balance, which means you're paying less and less interest over time. Whereas the money inside your savings account, that balance is always increasing. It's compounding, which means you're actually earning more and more interest over time. And so when one account is a decreasing balance and the other account is an increasing balance, there's always going to be a crossover point. And that crossover point represents that, technically speaking, you can borrow money at a higher interest rate than what you're earning and still make a profit, as long as one account is a decreasing balance and the other account is an increasing balance. Now, this example shows the power of not interrupting the growth of your money. And when you interrupt the growth of your money, you lose out on all of this interest that you could have earned. Now, if you want to protect your assets and continue increasing your wealth every day for the rest of your life, if you want to add guaranteed tax-free income to your retirement, or if you want to learn how to function like a bank and profit like a bank, click on the link below, schedule a time for a call, download my book, Function Like a Bank, Profit Like a Bank, watch some videos, learn more about the process. Thank you.